The economy isn't in good shape, and I know many of you might be affected by inflation, higher interest rates, outrageous gas prices, and a retirement account that is rapidly losing value. I totally get it, and in today's video, I'm covering how to manage your finances in a recession and how I personally designed my financial life to be recession resistant. If you want to learn more about how to ride this recession wave and how to come out of it ready to capitalize on a new market cycle, this is the video for you. On this channel, I discuss living globally along with business hacks in real estate and healthcare, showing you the path so that you can do the same. I want you guys to be able to go out there and live your dreams. If this is the sort of content that you want more of, subscribe and turn your notification bell on so you don't miss a thing. My name is Carl Pierre, and this is ENTP Life. The best things that you can do for me when watching my videos are to like the video, subscribe to it if you're not already subscribed, and share this video with your friends that are interested in the topics that I cover. Those actions put the YouTube algorithm to work and it helps promote my channel. So please do so, and thank you very much for the help. Moving on to the topic of today's video, it's important to explain what a recession is. To put it simply, a recession is an economic decline for a sustained period of time. Economists usually use declining GDP for 2 consecutive quarters to officially declare that we're in a state of recession. So this is the third major market downturn that I'm experiencing in my professional life. The first one was the dot-com bubble burst, which was in the early 2000s. And that was the first time that I saw the contraction of debt in the market and what happened to people's retirement accounts. At that point, a lot of people had invested heavily in the Web 1.0. And when that bubble burst, everybody got crushed, especially people who were amateurs at investing and anyone who had a lot of their retirement portfolio heavily invested in tech stocks. The next crash that I experienced, of course, was the housing market crash. And at this point, I had gone through college, I started to invest in real estate, and I got to experience that one firsthand. Again, my staffing company and my home care company were operational at the time. And what happened there is that all the banks got screwed, right? They were investing in crappy mortgages and mortgage-backed securities. And when that market imploded, pretty much the banking system almost collapsed. In that time, one of the things that happened is that they started to pull back heavy on issuing new debt. Credit card debt got evaporated, not the debt itself, but credit card limits got shrunken down to people's balances. Lines of credit got completely eliminated. A lot of the financial products that were in the market that made it easy for businesses to access cash and grow their businesses, all that came back. So what happens is that, of course, businesses stop spending because they have less debt coming in, and interest rates started to creep up a little bit. And of course, the government got involved and started to push money into the market back in March 2009. And that was the beginning of the next cycle, which we've been in. This most recent cycle goes from 2009 and, into my opinion, 2020 pre-pandemic. The boom that happened because of the pandemic was really attributed to how much money the government printed into the system. And now what you're seeing is the byproduct of that. So from 2020, like around March or April 2020, till January of 2022, the market was roaring. Why? Because there's a lot of free to cheap money that ended up in the hands of business people and investors, and all that free and cheap money got spent on assets. So that drove the demand for real estate assets, for vehicles. All asset classes actually in this time period went up. And of course, if interest rates were down into 2 and 3% on long-term debt, and the market, generally speaking, produces 7 to 10% annually, it made sense to borrow money and immediately push that money into the market, especially when there was a short-term dip in prices because of the pandemic. Because I've lived through 3 of these market declines, I've noticed a few trends, and I always do the same thing. So each market decline taught me something new, which allows me to actually push forward and make better decisions whenever there is another market boom. The economy is very much like the tide. For most people, when the economy is on the rise, they benefit, and when it pulls back, they get crushed. Here's what you could do to not get crushed in a recession. You see, a lot of people, what they do when they start making new money or big money, they end up expanding their lifestyle and actually putting more money into things like their home, their car, their clothes. You always see it with newly rich or young people who move into the professional world early in their life. they get this surge of money and they automatically adjust their lifestyle to like a upper middle class to even luxury lifestyle. They spend money on expensive clothing, expensive shoes. They upgrade their housing arrangements. They're paying $3,000 and $4,000 in rent just because they're single and they're making a lot of money, or they've made more money than they ever had before. So there's this weird mentality that we have in America where we're just a consumer nation. So the TV gets bigger, everything gets bigger because the earnings got bigger. And people forget what it was like in the previous downturn or what life was like prior to them making that money, and they just start wasting haphazardly. The downside to that is that they end up accumulating more and more debt. People in the United States aren't going out and buying homes in cash. Typically, they're using 30-year mortgages. They're financing or leasing their vehicles. And of course, we all know that automobiles are depreciating assets. Bad idea. So what ends up happening is that we end up putting our money back into the economy, which is great overall for the economy's growth. But for you as a person who's earning, you're not keeping what you earned. And in order to really move ahead and build wealth, you need to buy cash flow producing assets. If you're not doing that, you're making a major mistake. And usually when the economy pulls back, all these people look at the things that they've accumulated and ask themselves, why did I spend money on this crap? If I had more cash right now, I wouldn't be going through economic hardship. If I had more cash right now, I'd be able to buy these assets on the cheap. And because of that, one of the things that you need to do in all market cycles, I don't care if it's a boom cycle or a bear cycle where things are declining, you have to be conscious about how you're spending your money and making sure that you're allocating some money to buy long-term assets. It's off of these assets that are producing cash for you passively that you should increase your lifestyle, not on your earned dollars, not because your business is growing, but once your business is actually spinning off heavy cash flow for you, or once your assets are spinning off heavy cash flow for you, that's when it makes the most sense to actually start buying the luxury products and wasting money, so to speak. A while back, I did a video on the impending recession. I have some pretty basic observations that I use to detect the recession is on the horizon. And once I see these signs, I take action immediately. People thought I was crazy when I started talking about a recession is coming. You remember back in like early 2020, late 2019, I started telling people on the channel and even my friends, I really don't feel comfortable with this market. Most bull cycles, which are growth markets, are 4 to 7 years. And from 2009 to 2019, we had been going pretty much straight up in the US market. Because of that, I already started to feel uneasy because we're starting to get way past the typical bull cycle. Another thing that I noticed was that I started getting a lot more credit offers. That's usually the sign for me. When I was in my early life in like 2000, 2001, during that recession, what happened, I didn't have credit. I wasn't even thinking about credit. So I never really got offers or really cared about credit. But in 2007, 2008, when the market was crashing from the housing market bubble bursting, I noticed something. I was getting loan offers for all my businesses. I was getting calls to take out mortgages. I was getting credit card offers in the bank left and right. And I was taking advantage of that because I was like, oh, this is great. I got money coming in. I'm able to invest in my business and do other things. And that's something that stuck out to me because never in my life did I get so many offers for new credit. So for me, when I'm looking at a market cycle and I see that we're starting to get a lot of money pushed into the economy and a lot of credit offers coming from retail banks and every lender that you can think of, I know that the hat is about to fall, and that's it. That's just one of my indicators. Another thing that I look for is that everybody, even people who don't invest, start investing in some asset class. And in our era, it's been a lot of people getting into real estate because real estate has been doing good. And I do encourage people to invest in real estate. But you start getting people who really don't understand flipping houses, who've never done it before, who see other people making money and decide that they want to take their shot at it too. They've never even managed a construction project, but they're trying to gut renovate homes for the first time. Really bad idea. You also get people investing in the stock market that traditionally have never had a stock market account or in a trading account. And they want to trade or they want to start investing because they see everybody else is making money in the market. In this cycle, we had something unique and special, the crypto boom, which makes absolutely no sense to me. It's not something that I invest in. I know people here on the channel hate when I say this, but I will not invest in crypto. I don't think moving my money from one form of currency to another form of currency is an investment. I think it is a trade and something that you could take advantage of short-term change. But I don't believe that I can buy money and that money is going to grow. That's just not something that I do. You guys will never convince me, and I don't care if your opinion varies from mine. It's just not something that I do. But we saw everybody investing in cryptocurrency. You got people buying fake coins, people that have no business making coins, inventing coins and selling those coins. It's just an absolute frenzy. When I see that happening in the general public, where the taxi driver is talking about investing, where the TSA people are having a heated debate about which cryptocurrency is going to take over, and people that just don't really know anything about investing, don't really know what is the average rate of return of the S&P 500, when those people are talking about investing and they're putting money to work, that's usually the last tier of money, and it's not the smart money, and that's where the smart money sells their assets. That's usually the top of the market as well. So all these signs I saw coming to fruition, and I was like, pump the brakes. I got to start building my cash reserves, cutting my expenses, and preparing for things to collapse, and really waiting out and seeing when I could get involved in the next cycle. To protect against inflation and downsides in the market, it's important to hedge against these changes by investing in things that will hold value over time and raise in value during these times. You might hear the term hedging thrown out in a couple of different forms. You have hedge funds, and you'll have financial gurus talking about you need to hedge against the inflation with buying commodities and buying other asset classes. And really what that means is that you need to invest in a way that you're not falling victim to the inflationary pressure or the changes in the general market condition because you've taken an alternative investment type or even an alternative position against the market itself. You could hedge by, again, if you're worried about currency declining in value, a lot of people go into the safe havens of the US dollar as one place to park up currency, or they'll go into the long-standing, which are gold and other precious metals, or even oil and commodity metals that are used to power modern civilization. Other people take hedges by investing in asset classes that are heavily consumed by people, like real estate, food products, and some of those commodities like copper that humans need for day-to-day survival, even investing in energy. If you look at what's been happening in this market cycle, a lot of the commodity stocks have been running wild. Why? Because there's pressure on the dollar because of how much money has been printed, right? It's devaluing the US dollar. And there's a lot of money coming into the US because of how crippled other economies were due to how they managed the coronavirus. It's a weird time, but either way, you'll see that others will hedge and protect against inflation by buying US dollars, buying gold, and investing in other asset classes that humans tend to need. More savvy investors and institutions will also hedge against market conditions by taking an opposite position on what the market trend is. Normally people are buying and hoping that the market goes up, but you could take a negative position and profit from that by either buying puts on the general market or shorting stocks or whatever. And that's another form of hedging against what is currently happening. So that if you have this negative position on the market because you believe the market's going to decline, you could actually invest in that negative position. And as the market declines, you're still earning more money. You could invest and take a negative position on currency. So as its value decreases, again, you earn more money. So these are things that you need to keep in mind. But if you want to keep it simple because you're not investing in kind of exotic products, you can invest in things that you know that humans need, because as inflation takes hold, people are still going to have to eat. They're still going to have to pay rent. As they're paying more and more rent and paying more and more for food, you're collecting that money, even though it's generally devalued, but you're controlling the asset that people are willing to exchange money at its current price for. So if you control that asset and the value is going up because the price of money is going down, you really don't get affected by it because you're still collecting. If you weren't able to invest in the last boom, benefiting from the growth in the stock market and the housing market, your only option is cutting your current costs to prepare for the next high tide. Unfortunately, as you tighten your belt, you're also contributing to the decline in the GDP since you're not putting money to work. To echo what I said earlier, you have to save your money, especially when things get tight. And the main reason for that is because as things get tight, every single recession that I've seen, the banks tighten up. Everybody gets scared. They all tighten up. And when they tighten up, they stop lending. It makes it a lot harder to get a mortgage. And when there's less money in the economy, there's less demand. People don't have as much money coming in, or they don't have enough cash to buy anything. And because everything is getting more and more expensive and they're not earning more and more, they start to get more frugal. So as their demand declines, of course, asset prices and product prices may decline as well. So as these things are declining and the banks aren't lending, if you don't have cash, you can't take advantage of these assets with your own discount. It's at these times where it makes sense to have a car that's paid off, so you're not paying a monthly note, that your debt is low, that you're not spending money frivolously on things like eating out and partying and buying tables in Las Vegas, which of course is like 1,000% inflation on a bottle price. Those things you need to cut back on, especially during these times, because that money's going to come in handy later. Finally, most recessions are about 1 to 3 years in length. In this time, the first movers have made adjustments, cost contained, and have started looking for growth opportunities. The tragedy in this is that most lenders, investors, and the general public are still shell-shocked, and money is not moving into discounted assets as easily as it was before. This is why getting aggressive with savings and making sure you don't kill your credit during a recession is crucial. By keeping your debt low and by lowering your expenses, as I mentioned before, you're able to save a lot of money and you're able to keep your credit in a really good state. Remember when I told you that the bank started cutting people's credit limits? If you think about how your credit score is calculated, it's your total debt compared to your credit limits. If you ever seen that you max out on your credit card because you made a large purchase and you're trying to build points, at the end of the month, your credit gets crushed because you overutilized your credit. So when the banks start reducing your credit limit, it also hurts your credit score. Even though you're not taking on more debt, it's just how your score is calculated. So if you are smart about keeping your debts low, reducing all your expenses at the end of a market cycle or right when a recession takes hold, you're going to be able to hoard more cash. And as the banks pull back on their lending practices, you become king because no one has cash. Most people had overspent right before the market collapsed. They bought a new boat, they bought a new car, they've been paying that monthly payment because they were scared to hurt their credit. Their credit has gotten killed because they're over leveraged. Those who have cash are the ones that are able to move quickest. If you look at what Warren Buffett has been doing for the past, 3 years, he's really been keeping it tight on new acquisitions. Why? Company valuations were too high, things just didn't make any sense, and he knows that at some point the market's going to collapse, and that's when the cash that they've been hoarding, the billions of dollars over at Berkshire that they've been hoarding, will be able to pick up assets on the cheap like they have done in almost every cycle for the past 30 or 40 years. So it's important for you to kind of imitate those same practices because this happens over and over and over again. When I was going through, one of my hardships, 2008 to about 2012 was an effed up time for me because I fell victim to that thinking. I was out of college, expensive car, I was making money in my business, so I was spending money a little more haphazardly, took on a lot of debt. This example that I'm giving you actually happened to me. When the market crashed in 2009, all assets were pretty cheap. But guess what? No one was lending money on real estate. The banks didn't believe in real estate anymore. They had just gotten hurt by investing in real estate. Hard money lenders were far and few, so there wasn't a bunch of cheap money. In fact, hard money rates were between like 12 and 15% so that you could invest in real estate. And they were super tight on who they lent to. And the reason they were super tight is because they had no place to resell their debt. Banks weren't buying that debt. So they had to actually use their own cash and really make good decisions about who they invested in and what they invested in. However, if you were cash heavy at this time, assets were like 50% discounted, 60% in some markets like Phoenix, for instance, got hit pretty hard during the last crash. So if you had cash because you took a more conservative approach, in that time you could have been gobbling up a bunch of assets, making really good investments. Even the banks that were holding on to a lot of bad debt were selling off that bad debt pennies on the dollar. So homes were getting transferred to those who had money, like BlackRock, for instance, that had a bunch of money that were able to say, hey, we'll buy that bad debt from you and we'll buy the underlying assets 20% on the dollar. And that was happening. If you don't have the cash to do that, you're not going to be able to do that. I really hope these tips for navigating the recession help you avoid financial ruin and prep you for wealth building in the next market cycle. Thanks again for joining me here at ENTP Live. Like, subscribe, and share this video with anyone you know will find it useful. Until the next one, take care.